one, Scott was already a dad, became a dad once over again just recently. And so his stockpile and bank of jokes is just getting better and better.
Yeah, my skill sets are growing, I guess you would say. The more children you add, the more your dad joke superpower increases. So I have a doozy for you guys today. I hope you're ready. Here it is. Drum roll, please. Why are balloons so expensive, Matt?
I don't know.
Because they've been inflated.
Oh my gosh.
We're talking about inflation.
Brilliant.
Balloons
very clever.
Deal with inflation too.
Right? I love it.
It's only getting worse from here, folks. Good luck on this ride.
Not only was it a great joke, but it was on theme with the topic for today. So I'm impressed. I'm sure you're getting hand claps from everyone behind the screen everywhere else. So we did have a couple questions come up. The Courtney did clarify that will be inside. The happy hour will be inside. And the title of the book is, I believe, we finalized spending money and having fun. It's along the theme of what we talked to our clients about, is really teaching them how to spend their money. So great questions. All right, as we usually do, we're going to set this up as a fun and friendly quiz. So there's going to be some interaction. In just a few minutes here, we're going to pull up a poll that we will ask each of you to go through and answer those questions. And then we're going to go through those together. And we're going to go through a few pieces of education before we dig into that. But whenever we have a larger group like this, we're always going to have people on the spectrum of very, very knowledgeable and experienced all the way to very, very beginner level. And so I always think it makes sense before we dig into any topic whatsoever that we just define what is inflation. So Scott, what do you have for us? What is the definition of inflation? What are we talking about today?
Awesome. Well, I'm going to share my screen here to help depict this, because I think a picture says 1,000 words, but focusing in on the top left side of this corner of the screen here, inflation is pretty simply and easily defined. At the end of the day, it could represent both sides of this story, but it really just means the increase in prices of consumer goods and services over time. The economy is expanding, therefore there's more in it. And one of the mechanisms to keep up with that expansion is how much does our dollar, or how much is our dollar worth at any given time in terms of the grand schemes of the economics. So as prices of things go up, that's one side of the equation, but the other side is that the value of our dollars decrease, right? That's the kind of the yin and yang. So that's ultimately the definition, and everything else you see on the screen here, we're going to get into following the fun and friendly quiz here. So we'll put a pin on this, but pretty easily to say inflation is the increase in prices and the decrease in the value of your dollar over time. All right.
All right. Perfect. All right. Excellent. Without further ado, we're going to put on some music and we're going to launch the poll here. We'll give everyone a few minutes to go through this. And please remember, nobody's going to see your particular answers. Please go through and answer all of them. No one's going to point and laugh if you get any of them wrong. We do occasionally try to trick you. That's not because we're mean. It's because we think that's the best way to actually be educated and learn some of this stuff. So without further ado, I'm going to go ahead and launch the poll, put on some music for you, and we'll give you a few minutes to answer all these questions. So, all right, everybody. Looks like we have most of our answers in. We're going to go ahead and share the results and begin going through some of these answers. And I'm excited about some of these because I think we have a pretty even distribution on some of these. So I think we have some stumpers in here. But Scott, take it away. Question number one.
Awesome. I was excited to see the results for question one come in, because it was not until very late into the timer that we saw a couple come up for good. First question, well, not really a question, almost a statement, like, what is inflation? And is it good or bad is really the question we're trying to get around here. And the first thing I want to point out before I get into some like actual answers here is it most likely will depend on you and your scenario, right? How you are viewing things it's important to understand is very different than maybe how your neighbor or somebody on the other side of the country is viewing things. So I'm going to get into some general conversation about, not just what is inflation, what causes it, and how those impacts could be either good or bad. So the answer to this question is, in fact, that it is a trick, right? There is no right answer, and it ultimately depends on, who you are, what you're dealing with, and where we sit in economic terms, or where we sit in history. There's certain events that will dictate inflation rates. There's certain things that you can do that can protect you or take advantage of inflation rates. So in general, it's not good or bad. It really just depends on what you're dealing with underneath the scenes. Because ultimately, inflation is a part of our economic structure. It's there. It's always going to be there. And as some of the questions later in the quiz asked, like, how bad has it been? During what times has it influenced our lives more than others? But as you can see, there's a lot of things on the screen that we're looking at, right? And I think the easiest way to understand inflation is the top right. The average cost of a movie ticket over the last 100 years has gone up substantially from 7 cents, right? That's inflation. That's all it really is at the end of the day, is something like that increasing in cost over time. And that same dollar we spent in 1910 doesn't get stretched as far as it does in today's day and age. And that's basically driven at its core, as one of the other questions that we asked, through the mechanisms and the economics of supply and demand are big drivers of what causes prices to go up or go down, right? Like when the economy wants something, when people are looking for some sort of item or service, it becomes more valuable. And therefore, that's what's going to dictate the rise in cost, and vice versa. Right? If somebody offered you a VCR today, it's not going to be worth a lot of money in your mind, right? It's just not a product that's in demand. And so examples like that make it, in my opinion, very easy to understand what inflation is. But like we were talking about before, how it impacts you is very different. And that's really related to the bottom left hand of the screen. Like, what's causing it, right? Is that thing you need getting hung up or more expensive in the economic structure because of problems with supply? Like there's no oil reserves available, for example, or there's a war going on in Ukraine that is changing how we get oil in this country, and that's changing the price of it. All right. But a lot of it does come down to things like monetary policy, which we're not going to spend a lot of time going into this. I probably already dove way too far into my explanation here, but there are factors at play that we don't necessarily have a lot of control over. Now, we can maybe argue that we vote in monetary policies and have people take the reins over those decisions for our country. But ultimately, they're around and they're going to skew or change the perspective of our dollar and how we use it in the world. And depending on who you are, you're going to, like I said, see that as positive or negative. Like wages may increase due to inflation in one market because there's so much more need for people to work and create that, good or that services that they need to pay people more. So that's definitely a positive. If more and more people need financial advice and they're knocking on fiat's door, right? That's a good thing for us in our minds, because as a business, we're trying to help as many people as possible. And that will dictate kind of how we go about things. It could also result in changes to your tax scenario, right? Which could be negative in your mind. But ultimately, how these things kind of boil down and impact you, it's important to understand what inflation is going to do to your plan. And I think we'll always kick this back to talk to your advisor, talk to us, like understand how these mechanisms going on in the world, the stories you're hearing and the news headlines, what that could mean for your planning moving forward. And then you get to decide whether or not inflation is good or bad, in my opinion. But a lot of this is not in our control, but how you plan around it. There's some mechanisms to take advantage of current times, for example.
Excellent. Well said. So what you're saying is inflation is a normal thing, and it has existed and will continue to exist.
Yeah,
okay.
It's not going anywhere. In fact, question 2, if we're ready to move on, Matt, I think does a great job kind of describing that, right? A lot of people are concerned with the news headlines in today's markets, in today's world, about current inflationary rates. And, we should be paying attention to them. Like if you're not thinking about these things, then your financial plan might not be as well rounded as you think. But ultimately, you know, what have inflationary rates look like have been very different throughout the history of this country. And so when you think about the options on the screen there, all right, there's a lot of changes that have taken place, like I said, due to external events. You know, we're looking at timelines like World War I and World War II, like stuff happened in those periods of time, right? Like that influenced the way that the world connected and how the prices of goods and services were, you know, laid out and kind of constructed. And so the real answer to question number 2 is A. All right, is the first one. 1778, inflation rates were tracked at just over 29%. All right, and so a couple years after this country was founded, there was some substantial growth that took place, right? And here's a chart that kind of maps out all the way up until about today's day and age, where we've been at different times in inflationary levels. And there's been times where the value of your dollar has gone up because of deflation. And Matt's going to talk a little bit about like some of these terms and definitions in a minute. But one thing we want people to understand and why we ask this question is to go back to your scenario doesn't have to be fearful of what's going on in today's markets as it relates to inflation. The fear of the unknown or not really grasping how it relates to you is probably driving a lot of the concern or thoughts. But there's been way worse economic scenarios than we're facing today in terms of inflation. And you got to understand, like, it's going to come back again. It's going to change. It could go up, it could go down. And there's a lot of mechanisms that are going to control that, right? There's all these different components at the bottom, you know, that go into what we use to measure inflation, primarily known as the consumer price index or CPI. Like any one of these categories could cause a huge spike or a huge change in inflationary rates. It doesn't have to be everything. And so it could be a mixture of all these things, or it could be very heavily weighted in one segment of the market. And that's one thing we got to understand. I learned while going through this, and I shared this with Matt, and he thought it was interesting. They actually have a marker of inflation that tracks the cost of Big Macs. It's an alternative marker for inflation. I thought that was a very interesting fun fact, but I thought this was a good way to just showcase, like, look what we've been through in the history of this country. And, you know, in your lifetime, you can definitely pull out a lot of different events that have caused some rough times in terms of inflation. So,
you know what I'm most excited about this question is only 22% of the answers were the correct one, which means we all learned something.
Not everybody. A couple of people knew what was going on.
A couple people knew, but a lot of people learned something new. Which...
Fair enough. Fair enough. All right. So we're moving on now. Go ahead, Matt.
Question number 3.
All right. So as I was pulling up before and discussing as we get into our deep dive into what is inflation, it looks like most people put their eggs in the basket that covered every answer here. And you're not wrong. There's a lot of things that cause inflationary times, and the correct answer to what causes it, you know, supply, demand, monetary policy, is it war? The biggest influence on inflation, I would say, is really you and I, right, Matt? It's people in general, right? The markets as we see them and where we put dollars and how we choose to spend it is really just a reflection of us. At the end of the day, how you choose to spend your money is just multiplied out, or where you choose to save your money is just multiplied out like millions and millions of times over. And that's what creates the economic structure. And so when you think about what driving force is really behind all of this stuff, right? Like even war, even monetary policy is going to be driven by what we are doing as a society, right? You think back to times like COVID and what we were doing, right? Like we chose to shut down the country, and there needed to be something to keep things going. Monetary policy stepped in to keep kind of a status quo. But does anybody remember what happened with things like toilet paper? Like just absurd, crazy things that people were thinking because they were fearful and weren't sure how that was going to impact their future. They made decisions. They bought and sold things that were based on their beliefs and what they thought was going to happen. And in reality, we've gotten through it in terms of what the market has experienced, and monetary policy kept things alive. But ultimately, the demand and the pull, the availability of all of these things and what we're looking for are the primary driver behind it. But you can't discredit, what the lawmakers are doing and the Fed and their, ability to influence things like inflation or things like wars or natural events that just create the circumstances we're in. So it is something you guys got to understand, from my opinion, is that there's many, many factors. And I think as long as you have a broad-based approach and you're looking at these things and collecting data that relates to the causes of this, then you can make very good, sound, informed decisions. Like having a rules-based approach to how you deal with money and creating certain indicators to track, knowing how we've gotten through things historically over time are really important components to making good decisions in these times. But yeah, it's ultimately just up to you and I, Matt, at the end of the day, not as advisors, but as consumers to, make this go. And
I'm glad you clarified that.
Yeah, not just as advisors, but everyone on this workshop as well is a big part of what is or isn't causing inflation at times.
Perfect. Excellent. We had a few questions come up about providing the PDFs of some of these things that we're going through. Scott, if you know how to drop those in the sidebar, we can do that. Otherwise, we can send out an email to all the attendees just with a series of the PDFs that we do go through. I'm going to pull up a few different websites that I will reference that are places that you can go out and check. Those are PDFs that Scott was going through. And then we did have a question about the polls, and we had someone answer for us. So thank you. The Ray and or Liz answered with the polls. If you just click on the polls at the bottom of your screen, you'll be able to see the questions and the answers. So we will go through each of those. And I tend to get really entertained by if we can stump people. So I will go through those in some detail. So question number 4. What percentage of all the money ever printed to date by the Federal Reserve was printed in 2020? Let's think back to where we were at in 2020. Not that long ago, probably in the near future for most of us, more than we'd like to remember. But early March, COVID became a real thing, in the United States, and we had essentially a worldwide shutdown. So all the things that we were talking about, supply, demand, income, everything kind of thrown up in the air. The really interesting thing is the most recent comparison point we'd have is to think back to the financial crisis of 2008 going into 2009. And if you compare the speed of response of the Federal Reserve actually stepping in and essentially both sides of the aisle when it comes to Congress, not being 100% agreement, but more of a consensus, the speed was just incredible. As a matter of days instead of a matter of months in crafting a response. Now, you can look at this and I'm going to go through the answers. So first answer, 18%. 48% of you chose that. So 18% of all the money ever printed in history was printed in the year 2020. Second answer was 50%. 17% selected that. Third answer is 5% of all the money ever printed was in, and 17% chose that. And finally, 1.3% and 17% of people chose that. We did not stump you. You were correct. It was 18%. And if you think about that in terms of the history of the Federal Reserve, that's a staggering number. Now, what I would like to clarify further, our intention is not to throw out some crazy stats to scare people into taking some sort of action. That 18% number is staggering, and it is kind of amazing when you think about it. And it's also concerning to a lot of people. So those numbers don't add up, right? There's definitely a blip in the radar when you look at that. One thing that I would like to encourage people to do is, no matter what we're talking about with all this stuff, you can find a headline that's going to pull one of these things, and it's either going to make it sound like it's on this side of pessimism or on this side of optimism. Very rarely, unless you dig a little bit deeper, are you actually going to get the details. So if you look at that 18% number, yes, that was what was actually authorized. Does that mean that that was that total amount of money was actually printed? And the correct answer is not, technically not. So it was authorized. It was a quick response to address a disaster. Regardless, it is still a very, very large number. So when you're looking at inflation, then obviously that's something that would be of concern. So bravo to everybody for answering correctly. Good job. For those of you that selected 18%, good job for everybody for selecting something. And thank you for participating. All right, I'm going to go on to question number 5. So question number 5, and again, just a reminder, you can click on the polls and you're going to see the polls at the bottom of your screen. You'll see each question and each of the answers below. What was the term given to the economic landscape in the time periods between 1974 and 1975 and 1978 and 1982? First option was inflationary. 22% of you selected inflationary. Second was stagflation. 33% selected stagflation. Third was correction. 13% selected that. And finally, recession. 33% of you selected that. This is kind of a trick question because there's likely more than one correct answer. The answer we're looking for here, because we're talking about inflation, is the second option, is stagflation. So let's define what stagflation is versus inflation. So inflation, when we're talking about inflation in general, goods and services that we go purchase are going up in price, and also in turn, income going up. So inflation, we see both of these things going up. The big difference between inflation and stagflation is in a stagflationary environment, the price of goods and services is going up at a certain rate. However, the rate of income is going down. Unemployment is also going up. So as you can imagine, that's not an ideal combination. So let's look at, we are going to pull up some interesting, just a pictograph of some interesting subjects that affect each of us on an everyday basis, and just see how much those have gone up from an inflationary standpoint. But when we take a big step back, which I always encourage us to do, and look at this as the big picture, going back to what Scott said before, when we have a large group of people, when we're studying statistics, we're going to go off of what we see in the numbers. Okay. So if I say, in general, we are all making more money, but you are not personally experiencing that, I understand that that's maybe perhaps a frustrating thing to hear. So just to reiterate Scott's disclaimer, in general, we are all making more money than we were before, and the cost of goods are going up. And at the same time, demand is skyrocketing. So I want to bring this to a real life example. For those of you that are plugged into Amazon in some degree or fashion, you've probably
heard of it, Matt.
Yeah. In some degree, you have experienced things that just don't make sense. So my wife ordered some pancake mix at 8:30 last night, and it arrived at our doorstep at 6 a.m. today, which is crazy. And part of that is, human potential. And there's a really interesting side of this, but there's also, how does that even add up? And so when we look at the big picture of this, we essentially, if we boil it down, we were all sitting at home in our underwear for 2020, looking at the computer screen and we wanted to buy stuff, right? So we wanted a new couch. We wanted new furniture. We're sitting in our houses for longer. I want to replace that chair. The demand for all these goods went up at the same time as the supply chain was going down because of logistic complications. So is this a good kind of inflation? Actually, yes, it is. Incomes are going up. Cost of goods and services going up. Are they going up at the same rate? Perhaps not. But this is what the Federal Reserve has been waiting for since 2009. So if we rewind back to the financial crisis, we'll get into some of those numbers that affect us personally, but the Federal Reserve has a couple different levers they can pull. And in summary, in 2009, they basically put both of those full steam ahead, and they were left there for a long period of time. So what that feels like to you and us is very low interest rates, a lot of money in circulation. It's easier money to access. And the whole idea of that is money's changing hands at a higher rate. So the correct answer was stagflation during 1974, 1975, and 1978 to 1982. All right, question number 6. I'm going to kick it back over to Scott.
Now, I hope I don't confuse everyone. I mean, who thought there was this much that goes into inflation, right? At the end of the day, it's even myself, we deal with these terms and these aspects of plans every day. And it's always fun to prepare and research at a deeper level for these conversations. But it's always amazing to see how things are always that interconnected, right? And you think about, as Matt was alluding to, like how we've evolved and adapted our systems and processes and understanding of these things as time goes on. Now that we have access to things like Amazon and the internet and computers to do a lot of this, the speed at which things move is much quicker. Like what Matt talked about in 2009, 2008, the financial crisis, it happened again in COVID. Like it was just much quicker. They pulled the levers and pulled them back. And yes, there will be implications for it, but these are tools. They're not, it's not a bad thing. As Matt said, that this happened. Like if it didn't happen, think of potential consequences, right? And so we also got to understand that how this interacts with our lives moving forward is also going to evolve and adapt. And like we have since the beginning of our existence, humans are going to create more and better ways of dealing with it. So just keep that in the back of your mind as life comes at us. We don't always know exactly how to look at this sort of thing. We're very intelligent creatures and we're going to solve our issues. That's what we're all kind of doing this together as a society, right? Much more difficult in practice than in comments, but I just love seeing how this stuff all connects and what's potentially there moving forward. But not to confuse you even more and layer in something that anyone that is on today's workshop that knows fiat, works with us, or has gone through any type of our deeper layers of education that we offer. Taxes are a big part of what we specialize in and help people with. And we wanted to kind of interlay this idea of, all right, we're going to talk about one aspect of the economic machine here today, but how does that affect something that we're all aware of and think about probably pretty regularly as it relates to money? Taxes are something that unless you're like potentially willing to go to jail, you can't get out of, right? You have to deal with them. But what's interesting about inflation is that it does impact taxes. And to look at the options, is that statement, your taxes are not impacted, true or false? It depends. Again, we don't want the attorneys jumping in through windows, yelling at us for things we say. Like these are general concepts. And I always want to reiterate when I get into comments like I'm about to say, come and talk to us and let's help you figure out exactly where you sit. Like whether you're a client of ours, like call us every day if you want to talk about these things, or if you're one of our, friends and family inner circle members, like give us a shout. We're happy to help walk through these things and give you some clarity. But for example, how do taxes potentially become impacted through inflation? Well, as Matt had talked about, wages are increasing, right? If that's one of the byproducts and end results or, mechanisms to inflation, you make more money hits the tax code, right? In your instance, more than likely, all right, depending on what you have going on to shelter yourself. But that's going to mean higher tax bills for you, right? Like if your wages increase enough, right? If you look back historically or what we're dealing with today, right? What inflation has looked like, if your wages increase in tune and you jump to a new tax bracket, you're paying more in taxes. Like that's potentially a negative impact to you. So you got to think about that, right? If as our wages increase or Social Security increases and all these things increase, like more money hits the tax code, right? So that's one thing to ultimately take a peek at year over year, see how these things are impacting you. Like you're just going to spend more money. The cost of we were laughing about this, right, Matt? Like how much does a stalk of celery cost? I have no clue, right? I couldn't tell you exactly one. It's definitely more expensive today than it was 20 years ago. And so when you go to the grocery store and you spend more money, right, you just have more to take out and more to withdraw, and potentially, especially in retirement years. And then you have to potentially concern yourself, depending on where you live in this country, sales tax, right? Celery costs more, you owe more in taxes on that purchase. You need to pull out more money to buy it. You're getting hit potentially in two ways. So examples like that are around every corner. And a well-defined plan is going to help you overcome some of these like trickle-in effects. Think of like compounding growth in terms of investing. Like that's compounding loss over time, right? As these things grow and grow on top of each other. Another great example, and I'm not going to be able to go through all of them here today, but think about your homes, right? One of the questions we asked was, what's the best asset class, or what has been the best asset class is maybe a better way to look at it, because we're disclaimer city here today. What happened in the past, guys, does not mean it's going to happen again in the future. We just got to use it as reference to make good decisions, right? But real estate is an option. You can go and put money into real estate, invest in it, and we'll talk about this in more detail, but historically it's done pretty well. Or you can find a lot of news articles and blogs and workshops out there that talk about how real estate is the best way to invest your money during inflationary times, right? But what happens to your taxes when property values go up? We all pay property taxes every year, right? And if the value of your home is increasing year over year, that property tax bill is going to increase in tune. And that's something that I'll tell you from experience, most people on this workshop have not thought about it. And most people we talk about don't think about those nuanced interconnections. So it's just, again, it's fascinating to me to see how one thing in our entire system could trickle down and create so many positives or so many negatives, right? And that to me is what's so great. But always, always, always think of it in terms of what's happening to you, right? What's happening to the global markets and here in the US, and then you, right? And understand the impacts of these things. So chances are you are impacted from a tax perspective due to inflation. But again, that may very heavily depend on your scenario. So answer to number 6 is false, in my opinion. Taxes are impacted by inflation. So that's my spiel.
Excellent. Thank you. Let's move on to question number 7. What was the COLA, or cost of living adjustment increase for Social Security income effective for 2022? The first option is 3.2%, 24% of you selected that. Second is 0%, 4% selected that. 48% selected 5.9%, and 24% selected 1.8%. The correct answer is 5.9%. I'm excited that 48% of you chose that, because we've actually referenced that in some of our inner circle workshops, which means you have tuned into either that or the podcast, because we talked about this pretty extensively. We talked about this pretty extensively at the end of last year. So keep in mind, the effective increase for 2022 is announced in late 2021. I believe it's October. I don't know the specific date. It's in the fourth quarter of 2021. It's going to be based on what was experienced that particular year. So looking forward, one thing I do want to go through that I find fascinating, not certain that everybody will, but I have likely, if you have been in the office and I've talked to you, you have liked this this likely looks familiar. And this is the cost of living adjustment for Social Security income since 1975. So here we are, January 22, the effective was 5.9%. What I find really fascinating is you look at this, let's go back to 2009. So 2010, 11, 0, 0, we had a 0 in there in 2016, 0.3%. These are typically average numbers that you'll see when we are looking at everything from a financial planning perspective. This right here is typically what we expect to see: 2, 2.8, 3.3, 2.3. We see this jump to 5.9%. The last time we experienced anything that high was back in January of 2009. And for those of you that remember, it was late 2008 when we began to hear the big banks, the announcement of Bear Stearns, the big banks, and then it was kind of just an eerie time. We hit basically the bottom of the barrel in March of 2009. So when you look at this 5.8% number, this is not an in any means a doomsday prediction or trying to pick out a pattern. It's just a fascinating thing to see. And then you have to go all the way back to January 1991, the last time you saw that above 5%. So January 1991, we're at 5.4% throughout this whole range. You see this in a more normal range that we'd expect to see. Then going back to 1980 and 81, we have 14.3% and 11.2%. I'm going to get into just the perspective on this in a little bit more detail over the next two questions that I think are fascinating from the standpoint of our response and all the biases we have as humans. So Scott mentioned before, we're very intelligent creatures. We also make the same silly mistakes over and over and over again. So if we can better understand that, then we can better understand our behavior and our response to all the stuff that's going on in the world around us. We did have a question come in. I want to reference. Someone asked me to make a prediction. I won't do that. So I don't make predictions because I don't know what's going to happen, and I don't think really anybody else does. So if you'd like to chat further about it and how it could affect you and look at on paper how that could work out in one scenario or another, that might be something that's worthwhile. But I don't make predictions. Scott can if he would like, but it's not something that I do. So
I'll make a prediction on what's going to happen with inflation. I'll go out on a limb. It's going to change, right?
It's good.
Right? Come on. No, I'm not. I'm with you, Matt. That's not what we do, right? We don't have crystal balls or, cards to read the future off of. But I think what's, the way I look at this, and you got to take numbers and statistics into consideration. Like, history does repeat itself in a lot of ways, but it's mostly because of what Matt said. Humans repeat themselves, and that causes trends. And so we will see inflationary times that are higher than others as we move forward. And it's going to go up and down. You can reference that graph I showed you right earlier, that if anyone wants to tell me that they got it, I put it in the chat. Please let me know. But it's going to change, just like the weather, right? We know that there's seasons and certain things to expect at different times. But other than that, your guess is as good as mine. The key is to be prepared and flexible, in my opinion, to accommodate them.
Excellent. So we're at 11:48. We are coming up on question 8 and 9. Both of these are going to be very similar to the previous question in that they're just historical numbers. I'm going to pull out a couple of graphs. I think it's fascinating just from a perspective standpoint. So question 8 and 9 are going to roll into one another. This is a really interesting thing for me when I'm talking to people. I love to hear people's stories about how they remember these things, because this next question, what was the average interest rate for a mortgage in January of 1982? And shortly, I'm going to pull up a graph that just shows the historical perspective of that and how much that can bounce around from month to month, even within a year. So if anyone could have told me that answer without being provided those, I would give them a $20 Amazon gift card as well, if they knew that off the top of their head. But the options are in January of 1982, and it should clarify on this. The mortgage is a 30-year mortgage, and this is an average. Again, 5.68%, 4% of people selected that. 8.92%, 35% of people selected that. 0 selected 4.08%, and 61% of people selected 17.48% as an interest rate on a 30-year mortgage. That is bonkers. And that's the correct answer. So 61 of you presented that. Probably, maybe a lot of you were going through that process at that time. And that's something that will stick in your mind. Now, I want to roll into question number 9, and then I'm going to pull out the graph and then just provide a little bit of commentary on looking at that. So what was the average interest rate for a 30-year mortgage in January of 2021? So 59% selected 2.74%, 35% selected 3.45%, 7% selected 5.34%, 0% selected 6.23%. The correct answer is 2.74%. Those two numbers are back to back, 17.48% versus 2.74%. That is crazy. And one thing I would like to point out here is we get to have these conversations with people day in and day out, that have to do with money and decisions and everything else. Well, first, let me share the historical breakdown of this. Just real quick, this is coming from that previous page I shared, just came from ssa.gov. This particular page is coming from Freddie Mac. So you can actually look up what was the average 30-year mortgage going back to I'm going to make you dizzy. Everyone look away for a second. 1971. So you can see month to month what the average 30-year mortgage was throughout history. One thing that, and just a sneak peek, we're going to begin digging into this a lot further, is just all the biases we have as humans that in turn are biases that we have as investors, and how we can understand those and how we can formulate better decision-making based on understanding our own biases that we don't think we have, but we do. So when we look at this, I just think this is a great exercise to realize from a perspective standpoint, what that all looks like. You know how many times we have the conversation with people, and I'm not saying this is a bad thing, but I would do the same, but complaining that I didn't get a 3% rate on my mortgage for a 30-year mortgage versus 4.37. In larger terms, in historical perspectives, 4.37 is still an amazingly low rate, historically speaking. But that's a perfect example of recency bias and how that can play into our behavior. So we believe that whatever has happened most recently will in turn continue to happen, unless we override that and we are aware that that's something that will happen. Mm-hmm. And like the point I really want to hit home here is just it is relative. So at the same time as that we see mortgage rates at 17%, guess what? We could go get a CD that was a crazy interest rate as well. So these things move together. What's most important is that we make decisions in response to that, just as Scott mentioned before.
I also think it's, we're talking mortgages and, debt is involved in that. When you take out a mortgage, you owe payments, and the interest rates are, what's going to dictate how much you pay over that time period, right? Theoretically. What people typically forget is how inflation actually factors into that decision moving forward, right? If you think about, you're borrowing a dollar amount of, you're borrowing money at one period of time that's going to be stretched out over the next 30 years, right? As inflation creeps up over time, as it does, think about that. Like you're purchasing a hundreds of thousands of dollar asset, right? At amounts that you're borrowing today that in reality are worth less over that 30-year period of time. So like even thinking about that in terms of a plan, like is debt bad and should we have it, should we not? Like you got to think in terms of that, like what you're paying for that asset stretched out over the time, how inflation gets rolled back into that should be accounted for, right? And so you got to think in terms of not only what's happened, but also into the future. And we don't know what the future holds, as we were discussing, but those components are vital, I think, in those decisions as well. There's a lot of science and math to consider at the end of the day as well. So something I was pondering as Matt was talking about mortgages. Are we on to question 10 now? We're running out of time here. I want to make sure you're muted, Matt.
We are in question 10.
Right.
There's really great questions coming in. So I'm hoping that we have just a few minutes so I can point those out before we sign off today.
Yeah, absolutely. I will be pretty brief on this one because you think about question 10, what was it? What's the best asset class to own, or what has been the best asset class to own is maybe a better way to answer that. And another chart for you, another graph that I'll throw at you. I think obviously this question really does need the disclaimer, it depends, right? Different asset classes are going to perform differently in the economics of this all, right? And the underlying mechanisms are different across the board for equities and gold and real estate, right? Like the things that influence those are not just inflation. So we have to account for that as well. When you look back historically, like yes, inflation rates may have been up, but what else was going on in the world to cause a change in that, right? Where you go in the globe as well would have an impact of that. Like you go back to World War I, World War II times, like hopefully you weren't living in a country that was being invaded, right? Real estate was not a good investment at that point in time, right? You think about that, like, hey, I just bought a new house in Germany or France or something, right? Like, not a good time to own real estate, even though inflation was running amok. So things like that, right? Maybe a bit of an extreme example, but when you look back historically, which asset classes tend to perform the best, you can see it on the screen here. And the options I threw at you were equities, fixed income, real estate, and precious metal. When you look across the top here and some of the comments that are thrown in at various places in this chart, generally speaking, the ups and the downs, right? Because there are times in the world where inflation wasn't the main driver of an asset class price and there was value lost, right? 2008, 2009 was a good example of that. Real estate was a tough market to be in for a number of reasons. But you can see right here that like 7 out of the last 9 years, real estate has beat inflation solidly, right? You can look into those specific numbers. And recently it hasn't lost as much, right? So you could argue that maybe real estate was the best place to ultimately be. But historically, long-term, the averages, taking the stats into consideration, equities are generally going to be the most sheltered and the best chance overall for just pure growth. Like, here's an example of one that, when you look just to one sector of an equity market, right? Like, energy itself is very volatile during inflationary times. And so you tell me, is that worth it for you? Just like, what quantifies best? You know what I mean? Is it more of a hedge of protection? Is it more for income? Right? We talk a lot about how to invest for the goals and the outcomes you're seeking, and everyone's goals and outcomes are slightly different. So someone might want pure growth to be the best thing that they seek in these times. And generally you're going to want, everything that we showed you on the screen in one form or another, right? Precious metals have done very well at times, right? And in general, historically, have had a better track record than what we're experiencing lately. But as I mentioned, this is a great kind of piece to hone in on. Like, what are we using precious metals for moving forward? Like, is the tradition of what they've done for us as a hedge to inflation going to be the case? Like, you walk up to me in the streets and go, I got a bar of gold for you. Like, I'm not whipping out $100 bills and trying to buy it from you at this point, right? I'm going to think long and hard about, like, what would I do with this if the markets went to rise and I needed it, right? Is there the market that I want for it? So you got to think in terms of like how you think and feel, and your philosophical approach when it comes to choosing the best class, but also the outcomes that you're seeking in your plan. So to me, the right answer was equities, right? Because I think it's the middle of the ground, the highest potential to earn historically, and a pretty good hedge against inflation in bad markets as well. Like, there's other factors at play right now in today's markets. Like, there's a lot of money going through companies like Amazon. The demand is there. Corporate earnings, which is a big indicator of value in the markets, is strong. So even though inflation is going up and up and up comparatively, money keeps going into the system. Owning Amazon's been a good thing over the last few years. And so I'm not here to say any one of these options on the screen is inherently good or bad. There's some that are probably better than others, like bonds haven't done historically as well, but they have very good uses for other reasons in your plan. And you shouldn't let inflation dictate why you not choose an investment, in my opinion. So there's no wrong answer. It's a bit of a trick question in my opinion, but you can argue either way. But I think in the pure statistics of it all, if you didn't answer A, you got it wrong. Sorry to say. But we got some really good answers on the screen. And I think my opinion, Matt, is we got some educated people in today's workshop.
Absolutely.
Right, because they're mostly our clients. But here, take a minute or two, answer those questions. No, I'm kidding. But
yeah,
it's a pleasure, guys. Thanks for the time today.
Yeah, for the sake of time, so we're at 11:59. Thank you. We had a couple people share their experience with the
that was fun.
they had way back when. That was super cool. We appreciate that. We appreciate you sharing that. The question about predictions does tell me that you are an educated person, because you asked about a deflationary period, which we didn't even get into. Again, not enough time for us to make a prediction here, and I don't make predictions, but that's that'd be a great thing to chat with somebody about. Another question, we had a couple questions about cost of living increase on Social Security. I think those are great questions. Yes, it is based on inflation. My homework for you that asked that is to figure out what the Social Security COLA increase is based on. So what price index? No, it's not for you. I want them to go look. So and finally, COLA does increase each year, even after you turn it on. We did have one more question about taxing Social Security that's not related to inflation. My favorite to you is to send out an email to us directly, because that'd be a question we would answer offline, as that's more related to a tax piece as opposed to inflation. So thank you all so much for joining us. We hope you had fun. We hope you learned something. I do have one last request for you, is to ping Brad and bother him about this book, because I want to see it come out. And everybody think of him in the Arizona sunshine while we were hopefully experiencing maybe some 40-degree weather, maybe 50. But thank you all so much. Thank you for attending, and have a great rest of your day.
Bye, guys. Have a good one.